For many, investing has led to handsome profits and tremendous financial wealth. Unfortunately, most investments don't offer stable returns. Many investors learned this the hard way in 2008, when the stock market plunged nearly 50% from its peak. Simultaneously, bond prices fell due to worries over the financial strength of many companies. Some retirees, devastated by these market crashes, were forced to go back to work. These people got hammered by what's known as investment risk. Investment risk takes many forms. Bad news about the economy, an industry, or a company can send your stock or bond tumbling in value. Then there's interest rate risk. If interest rates rise, an investment, such as a bond, could lose value if you need to sell. That's because nobody would want your bond unless they could get it at an extremely low price. After all, wouldn't most people prefer a bond with a higher interest rate? Rising prices of food, health insurance, and other things you might need can also hurt. This is known as inflation risk. Say you invest in a bond or CD today, and the price of food rises. Even though you might have locked into a great interest rate on your CD, its earnings could wind up buying you a whole lot less down the road than they once did. These types of investment risks can be tough to swallow. On the other hand, if you let investment risk scare you out of investing, you could also be shortchanging yourself. That's because accepting a certain amount of risk can also lead to higher returns. Take stocks. Historically, according to the Standard & Poor's Index of 500 large company stocks, the annual return on stocks during the past 70 years has been 10%. By contrast, lower risk government-backed certificates of deposit have averaged a bit more than 3%. Nobody can predict the future, and many experts believe stocks might not earn as much as they once did. Still, history tells us the longer you have to invest, the more it can pay to invest in higher risk stocks because you have more time to make back any losses. So what should you do? Consider a carefully balanced plan addressing each type of risk. With retirees today potentially facing 30 more years of retirement, riskier investments like stocks might wind up being one of the few ways to get your money to last a lifetime. Stocks, combined very carefully with other investments, might help boost your overall performance over the long term. Of course, you might also want to have a measured amount of low-risk investments. This way, if the markets do drop, you won't lose your shirt. Those lower returns wound up looking very good to many when the stock market dropped in 2008. Retirees who need their money right away might consider sticking with more conservative investments than those with more time left to make up investment losses. Meanwhile, if the stock market does decline substantially, you'd be awfully happy to have other investments like government-backed CDs. Here's where a qualified financial professional can help. By knowing the ins and outs of investment risk, he or she can use it to work to your advantage. The key to getting a grip on risk is selecting the right mix of investments, like stocks, bonds, CDs, and insurance. If some of your investments drop in value, others should rise in value. Plus, others should provide you with a steady stream of income to weather any storm. A well-trained financial professional knows the key to your financial success is a balanced investment plan, which you can adjust periodically based on your age, investment concerns, and the income you'll need. Understanding investment risks can help protect your financial stability and your peace of mind. Know your options and begin planning today.